what we have, all of this stuff that I've talked about has been related to portfolio loans. We're not really talking about conventional loans or conforming, Fannie, Freddie, agency. All of those names refer to the same type of loan. We weren't talking about that back on that last presentation of loan products. So now we're going to shift gears and talk about only conforming Fannie, Freddie, agency loans. So the way that agency loans work for interest rate pricing is everything starts out with a base price for a rate. Okay, so what I mean by that is maybe you start with a rate of 6%. Now you're going to have adjustments up and down based on many different factors. You're going to have adjustments for property type, occupancy type, loan to value or down payment size, loan size in general, what state the property's in, credit score. Those are some real common ones, but it changes from there. And then you get into different types of loans. If you have down payment assistance, then you might have another loan level pricing adjustment. So all of these adjustments are going to affect your final rate and pricing for that rate, whether or not you have to pay points or you get a lender credit back. So these are called LLPAs. And what that stands for is loan level pricing adjustment. And every single rate is made up of your base rate plus loan level pricing adjustments to get you your final rate. So when people are notorious for calling us and saying, hey, what's your rate? And it's like, I mean, that's such a loaded question, right? Because I don't know. What's your credit score? How much are you buying? What state are you going to be in? What's your down payment? Like, all these questions play into the fact, what's your rate? It's not like you just show up and everybody gets 6% or everybody gets 4%. It's going to be deal specific and many different factors affect. So there was a lot of talk in the news back in May and a little before then when it was announced, but the FHFA, which is the basically the governing body of Fannie and Freddie, it's the housing financing and housing association of the government, they made a decision that they are going to change the way that LLPAs are administered in certain buckets of LTVs. And what I mean by buckets is if you look at these buckets here, you're going to have these are the old LLPAs that were in effect before May 1st. So you can see here that when we have, let's just look in this 80% bucket right here. So 75% to 80%, you are going to have, that's a 20% down loan. Let's just say 80% is going to be 20% down. If you have a greater than 740 score, you get adjusted up, you get a hit for half a point. And you can see as the score drops down to 640, it gets more expensive. So your 740 borrower is going to get a half point adjustment. Your 640 borrower, 100 points down, is going to get a 3% adjustment. So that's going to change the rate substantially. Okay. And you can see here, these maxed out at 3.75. Like if you're trying to do 3% down conventional loan, it's going to charge that 620 borrower 3.75%. Okay. Now, on the new LLPAs that came out, you'll see that in that same situation, they made some changes here. See how this one, oops, let's see, my screen didn't flip over. All right, here we go. So this is the new LLPAs. You can see what they've done is they've expanded credit scores, and instead of 640 being the highest with no changes after 640, they've gone up to 780. So they've kind of tightened up the credit score bands, and they're manipulating those a little bit more. And then you can see they're not going down to 620 for adjustments anymore. Anything under 640 is getting that adjustment. So if we go back over here, before we saw a 3.75% hit to our clients that were a 620 trying to do a 3% down loan. Okay. Now it's only 1.75. So a lot of controversy was in the news, and people were saying, oh man, you're going to have the lower credit score people are getting better deals on their mortgages. That's not necessarily the case. Okay. I've got a video on this that I went into super detail, and I'm going to include it with the follow-up, but that really explains it with graphics and everything to really show you what's happening. So that's not necessarily what happened. What is going on here, I'll show you this heat map of the way that those things changed. So you can see that, let's say the borrower who had a 720 score and wanted to put 20% down on the new LLPA adjustments, they are worse now by half a point. That adjustment right there got worse by half a point. And you can see this heat map outlines what got worse and what got better, kind of all across the board. So you can see where that first example that I showed you, that 97%, they got 1.75 better So, what does this mean? It doesn't really mean anything to any of us because there's nothing we can do about it. It is what it is. This is how they decided to change their pricing because they look at risk, they look at performance, they look at historical data, and they know who pays what and where they lose money and where they make money. And so they've decided that they're going to squeeze a little bit more money out of the middle here. And this is your kind of vanilla standard, 15% down, 720 middle score. They're going to take a little bit more money from that borrower and they're going to take a little less money from these borrowers over here. Okay. Now, the biggest driver behind that is they say that it's going to open up more affordability for lower score, lower income type people to not be penalized as hard as they used to be. And they're going to take the money off the back of the kind of the middle and fund the programs a little bit more with that. So that's really what it comes down to. It's not as simple as saying, hey, I've got a 780 score, so I'm just going to quit paying my payments and get a lower credit score so I'll get a lower rate. That's absolutely not the case, because what happens is the base rate for these borrowers with a 620 score versus a 780 score is going to be much higher to start with to even get going from the first place. So if you look here, these are old rates. This is back from May, I think, when I put this together. But you can look here to say here's a 780 rate versus a 640 rate. Your 780 400K purchase, 20% down. At the time I pulled this, they had a 5.922 rate. Okay. But your 640, same scenario, 400,000, 20% down. They start out with a 6.996. So they're already getting a higher rate than the person who has a better credit score. And this nonsense about I'm getting penalized because I've got a higher credit score, that's absolutely not the case. That's completely not the way to look at it. You're going to always have a better outcome when you have a higher credit score. You're always going to save more money versus somebody with a lower credit score. So lots of controversy. That's died down. I haven't seen one news article about it since around May when it went into effect, and nobody knows, that our customers, anybody buying a house, what's your rate? That's the question they say. It's not historically what happened 6 months ago when this went into effect and what are we going to do to get that back? I'm not hearing any of that kind of talk. And the general public is not necessarily even aware of this. They just knew what was in the media at the time based on the headlines. And that's kind of where a lot of that controversy came from. A lot of people overreacted. So that's a little background on those LLPA changes. I think the biggest takeaway is if you have a borrower going to a big institution and they're getting told no, let's look at them and see, can they fit into one of these other buckets? Then can we get them a loan? And if they're a 500 credit score and they got no money and they're not able to make anything work, these products that I'm talking about is not going to do anything for them. But if they're going to be, if they've got decent credit, they've got some cash and they've got some income, whether it's documented through tax returns or not, let's take a second look at that and see, is there something that we can turn over and turn into a deal, which turns into them getting their home and a sale and everything else. So I think that's the biggest takeaway from this, is that there are options outside of just your standard denials.